Spencer Jakab, in the Ahead of the Tape column in today's paper, notes that while debt has continued to spiral out of control, $15 trillion globally, not globally, in the United States alone, what we pay in interest has not gone up. In fact, it's the same as it was back in 1995, believe it or not. Spencer Jakab, thank you for joining us. Am I missing something, or is that about right?
That's right. This year, it's actually going to be slightly lower than what we paid in net interest in 1995, of course, because the rate has come down.
Right.
Now, you know, America has this stock of debt. I mean, it rolls over.
Right. Where are we now? We're over 15 trillion? 15
well, we're over.
To 16 trillion?
We're getting close to 16 in terms of gross debt. In terms of net debt, we're a little over 11 because, you know, some of that is held by other government accounts. So on a net interest on our net debt. And that, you know, that's where we are,
right.
And that's because rates have been coming down. And you know, if everything keeps going the way it is going, then the rate that we pay on that stock of debt is going to continue declining because it's about 6 years is the average maturity of the bonds that are outstanding. And so, since we've had 4 years of very low rates, and they're lower now than they were a year ago, every time a bond rolls over at a higher coupon and a new one is issued at a lower coupon, it's good. And what I wrote about is that, you know, that the Fed, although, you know, Bernanke is out here saying, hey, you need to get your fiscal house in order, Congress, in his Humphrey Hawkins testimony, he's really been an unwilling enabler, you know, for this going on. Of course he's been an
enabler. This is my core point, which is politicians, there is no incentive, unless the bond market is freaking out. If you could borrow, if you're the U.S. government, you can borrow 10-year money at well under 2%, like right. Even today it's like 192, 193. The incentive to deal with the huge, gargantuan, uncontrollable, spiraling debt is there's no political incentive for you to do it, is it? I mean, politicians right. are not going to deal with the debt and the deficits until the bond market makes them, will they?
No, I think that is the historical experience. You look at, you know, Reinhardt Rogoff thesis. You know,
no, we don't have to go very far. We look at what happened in Greece, right? I mean, in Greece they kind of ignored the thing until the market finally said you can't ignore it any longer.
Well, there are dozens and dozens of examples like that through history because politicians are, you know, it's not their debt, it's our debt, and I mean, you know, they're in the business of getting reelected and making people happy, and they're going to keep on kicking the can down the road. And I mean, of course, this is an election year, and so you can say, well, after this we get serious. But Bernanke actually today in his Humphrey Hawkins testimony, he outdid his rhetoric from last year. A year ago, during his Humphrey Hawkins testimony, he called it a near and present danger. This time, yeah, I didn't think he'd be able to top that. He called it a massive fiscal cliff.
A massive fiscal cliff.
Yeah.
So he's doing a little CYA exercise, so that a couple of years from now, when they say, but you were facilitating this whole thing, he says, listen, I warned you guys. You know, I warned Congress, and he goes back to his testimony. He says, look, I said we're going off a cliff. Well, and yet, until the bond market totally freaks, what's the incentive?
I mean, the purpose of the stimulus and the bond buying wasn't to make it cheap for the government to borrow money. That's a side effect. And it's a nice side effect because let's look at next fiscal year. If you had the same rates that you had on the whole stock of debt that you had in 2007, the difference would be $350 billion in extra interest payments next fiscal year. So, but that's not why he did it. He did it to make home borrowing cheaper, to make all other kinds of borrowing, to stimulate the economy.
Now,
but it's you know, that's an undesirable side effect, is that the government's not acting.
Final question for you. The government, the Treasury, has different ways that it borrows money. It borrows money short, right? It can borrow money 6-month money, 1 year, 2 year, 5 year, 10 year, 30-year money. Mm-hmm. Do you think the Treasury's been too slow at switching out the short-term debt for the long-term debt? I mean, if we could get as much of this, why don't they go out and try and raise just 30-year money at 3% as much as they can?
Well, that might make sense. Then you can go, haha, you know,
yeah, you guys fooled you guys.
You're stuck with it if you're out to fool the market, right?
Right.
Actually, it has been lengthening because they reintroduced the 30-year bond, and so you had it close to about an average of 4 years at its lowest, and now it's been creeping up, and it's moving higher bit by bit because the 30's back. But maybe they should do it. I don't know. It's more expensive, but
do we have a bond crisis in the next 12 months? Final question, Spencer Jakab.
I don't think in the next 12 months, but we will.